Markets are the sum of all the expectations and beliefs of their participants. Sometimes in markets, all these different expectations, different views, they can be distilled into certain adages. In the case of Australian equities, that one adage, in my view at least, is the trend is your friend. What do I mean by that? I mean quite simply, stocks that go up are more likely to keep going up. Stocks that go down are more likely to keep going down. Now, when dealing with asset managers, in my view, it's very important that when you're investing in an asset manager, you find out whether A, they agree or disagree with this statement, and B, what their view is surrounding that, and C, if they do disagree, hopefully at the end of this talk, they'll have to have some strong reasons as to why. So in terms of our individual, almost interactions with each other through markets, there are a number of biases that we have. Now, the first one I'm going to talk about is this one, sequencing bias. Now, with these two sequences here, initially people have a reaction to these two sequences. Sequence B actually looks like it's more predictable than sequence A. And this happens in stock prices as well. You might see a stock that has gone from $10 to $11 to $10 to $11. You think it's quote-unquote range-bound. You think that sequence is predictable. The reality is that, of course, in this sequence here, this is tails and heads. They have the same predictability, and there is a probability that with the same predictability, both sequences can occur. Another example. Given $50, you're given two options. Scenario 1 and scenario 2. You're told you can keep $30, or you can gamble with 50% chance of keeping 50 or receiving nothing. Scenario 2, you're told you'll lose $20. Now, of course, they're identical. But what's really interesting about this is that research by Kahneman and Tversky shows that when things are framed in terms of losses, people are risk averse. You're much more likely to choose option A in the lower scenario than you are in the upper scenario. And this stuff, even though you see it here when you're using, arguably the more rational part of your brain, seems counterintuitive. It's the experiments show again and again that these things occur. This here is similar example. This is called loss aversion. Losses hurt twice as much as gains. Again, statistically, they're exactly the same. However, if you were told, could you keep $40 or risk the chance of losing the lot, but potentially gaining 10 to take 50 home, you're more likely to keep 40 than you are to keep 5. Now, again, this is something that I find very interesting because the reality is I personally would probably keep $40 as well, because you can actually, relative to your, that single event, I'll keep 40. Now, the key is that when you do this again and again and again, you're better off keeping better off doing scenario 2. So the reality is that our biases affect our decisions, especially when they're made under uncertainty. Now, there's a whole field that's based on this called behavioral finance that we've covered a lot of today, and it's the application of psychology to investing. And what I'm going to argue today, hopefully, is that these biases lead to behaviors that actually lead to the trend being your friend in Aussie equities. We're seeing that these biases really play out in the way that stock prices behave in Australia. So again, I'm going to run through a couple more examples here. When you frame conversation in terms of gains, you get risk-averse behavior. So a good example here is term deposits versus equities. Your term deposit is going to gain you 2%, your equities are going to gain you 9%. I'll take the term deposit, even though you probably have a bias towards that. Frame conversation in terms of losses. Insurance. People are generally underinsured in Australia. That one in a million-year event or a 100-year event, whatever it might be, is actually you should be insured against. You're underinsured. People prefer to avoid large losses and lock in small gains. Again, this is you see this in behavior in equities. When you hear people talk about it. I will sell when it gets back to my entry price. Is a classic one we sometimes hear. Myopia, too much emphasis on short-term information. Now, this is, again, we see this across the space, even in our institutional clients. You've had a poor quarter. How many more questions or phone calls do you receive as an investment manager or advisor when your funds are doing poorly? When in fact your asset allocation is probably correct and working fine, and this poor quarter is nothing unexpected. The final one I'm going to mention is anchoring. You place too much weight on the first piece of information received. Now that's like talking about yield stocks. If the first thing you say to your client is, this stock yields 7%, everything you say after that, if you were trying to then convince them not to buy it, you'd have to make quite a strong case, especially if they needed income in retirement. You're framing the way they make decisions. And all this is extremely important when you're actually talking to clients and thinking about finding out about their risk aversion. It's very important in the questionnaires. Stock example here. Bingo recently had a downgrade. So it was 15% growth, suddenly went to 0. Stock was down 45%, far more than the underlying fundamentals would suggest. Now, why did that happen? Ultimately, because investors basically then extrapolated that news forwards. Now, my argument to you today is that all these things, particularly in Australian equities, they lead to this trend is your friend, and it is something that is unique to Australian equities. Here's an example here. So CBA. Over the past 2 years, we've seen that, obviously the news flow with this stock and this whole sector of the market has been reasonably bearish. But looking at the stock price relative to the earnings snail trail, this is the earnings per share trail. In 2017, the stock price, the first news in August about Austrac, stock reacted far more severely than the fundamentals would suggest. Investors are already pricing in possible future risk. And the overreaction was so severe that was actually a buying opportunity, even though nothing had changed in the economy, the fundamentals, or in fact in Austrac either. We saw similar things in the Royal Commission through April 18, and sure enough, the earnings slowly were in downtrend, but the stock price far more volatile than that. So what's changing? The actual business hasn't changed. It's still a bank. It's still return on assets of not very much. Your yield isn't that different. What's changing is investors' interpretation of the information, and that interpretation is ultimately biased. And again, finally, you saw in February this year, you saw that very strong positive reaction when the Royal Commission news was released. It actually wasn't as bad as investors thought, and sure enough, the stock price went up a few percent on the day. Again, for a large banking business, a movement like that is unheard of in a way. So what can we do about this? If we're seeing all these biases playing out, how can we actually make sure that our portfolios are in line with these biases, are actually taking advantage of the way investors behave? Now, one of the key things about the trend being your friend in Australian equities, in my view, is that first we have to define what you mean. And it's actually a lot simpler than you think. Quite simply, that dark line has a strong trend, the grey line has a neutral trend, and the orange line has a weak trend. Now, you can build portfolios that go basically in a way, think of it, they go long the dark trend, short the orange trend. And they will do very well over time. Now, the reality is what we're seeing here is not just simply a particular strategy. What we're seeing here, in my view, is actually a reflection of the way investors are interacting with each other. It's not going to disappear tomorrow. I love these charts. This is, often we get questions. Okay, great. You've got got portfolios which exploit this trend. It's not going to be here tomorrow. It's not going to be here next year. People change, markets change. The way people interact with markets change. Now we've got Bitcoin. Reality is here is, and this is straight from the academic paper at the bottom of this page here. You can see that there was trend following behavior in the 1800s, right? There were no iPhones then. There was no internet. There was no screens at all, and yet they managed to find trend-following behavior in the 1800s. Not only that, but that behavior continued in the 1900s and continued again in the last decade. So something's going on here, something that's really is telling us that this stuff exists through time. So if you're going to make the argument to me this is going to disappear next year, you've got a lot of work to do in terms of the data, because I've got 120 years of history that disagree with you. Now, it doesn't mean to say you won't have bad years and good years, of course, but we're talking about averages, 5 years plus. So it works through time. The other thing I like about this stuff is that it works across asset classes as well. So again, what we're doing here is we're building the evidence, the biases that I mentioned initially, we're building the evidence up that yes, those biases exist. How are they reflected in asset prices? And the reality is that to do that, to actually think that you can make a link between that bias and the asset price, to make that link, you've got to go across time and across asset classes. You can't just do that with a single data point. And again, here's some more evidence. We've shown you across time. Here's across asset classes. This is in 1971. There's the paper reference there. This shows that trend following and momentum works in currencies, commodities, fixed income, and equities. That's enough asset classes for me. So something's going on here. These biases are being reflected in markets. So I've taken you through some well-established biases, and again, those biases were, they've generated Nobel Prizes. It's not something that's new to people. I've then shown you that those biases can be reflected in asset prices. They're reflected in the way that trends continue. When stocks go up, they generally keep going up. And when stocks go down, they generally keep going down. Now, one of the things that is new in this talk is that Australia is a special case. Why is it that when we think of portfolios, we think in terms of value or quality or momentum, maybe yield as well, and we're deriving that thinking from ultimately the US, the way they think. Even indexing down in Australia, the argument against indexing is stronger down here, given that active managers generally do better here than in the US markets. So the reality is that when you're investing in a particular market, it's very important to know how these biases are reflected in that particular market. And Australia is a special case. And hopefully, I'll take you through why. Now, these are simulated portfolios, so they're not, obviously, there's no trading costs aren't included here. No, they're not implementable. But $1 in 1992 in a momentum strategy, simple momentum strategy. So all I've done is buy stocks that have gone up over the last 12 months and sell stocks that have gone down over the last 12 months. And I rebalance my portfolio every month. That's all I've done. There's nothing complicated in here at all. There's no optimization. There's no trading costs. You've turned $1 into $101 with momentum. With quality, you've got $36. With growth, you've got $23. With the index, you've got $10. And with value, you've got $3, $3.44. Now, what's going on here? I mean, the amount of managers in Australia who say, yes, we're value, ultimately you should say, okay, that's great, but you've really got to justify why you're value. Because I can look at a factor and I can say, actually, look, a very simple measure of value, and here we've used price to book, so the book value of a company, the classic margin of safety that Warren Buffett's talked about for years, and so have other value investors. Doesn't work in Australia. Now, you haven't lost money, but the reality is you're a lot worse off than if you'd taken account of momentum in your portfolios. Now, what's really interesting about this chart, and again, this goes back to when you're talking to managers. In my view, if a manager's outperformed, they've almost certainly got momentum in their portfolio, even if they tell you they haven't. And this is something, again, that you should ask your managers. You say, well, what's your view on momentum? And they'd say, oh, I don't like it. I think it's crazy buying stuff that's already gone up. Okay, that's great. How come you've outperformed so well if you claim you don't use it, particularly in this market? And again, this this stuff is so compelling from a statistical perspective. We've been using this stuff in portfolios since 2009. This is something you can really exploit. Now, in terms of Australian equities, again, I want to highlight this is something that, in my view, is very important to be aware of as well. Like in Australian equities, you make about 1.6% per month on a naive portfolio, which buy stocks have gone up, sell stocks have gone down. In Japan, at the other side of the spectrum, you make less than 20 basis points a month. Now, per year, that difference is nearly 20% due to compounding. So in Japan, I would argue it doesn't really matter if you care about momentum. And the interesting thing is that all those bias experiments and those bias results we see that we've heard so much about, the key thing I want to emphasize here is there's a cultural element here. The reality is that factors work differently in different markets. And it's very important that your portfolios take account of that. So if a global manager comes to you and says, we have a factor portfolio, and it's a factor portfolio for the world, first thing you should do is show them this chart and say, well, why have you done that? Because in Japan, I should have more value, and in Australia, I should have more momentum. You're leaving money on the table. Now, the question is you've got all these bias experiments. Why is it that in Australia, we have such different results? And these results are huge in terms of, $1 became $101. With value, you had $3.30 after that, from 92 to 2018. Reason is, and this is again published work, and again this is still a little bit, the whole idea that biases have cultural influences is a reasonably new one, and not one you'll necessarily hear from general psychology talks in terms of equities. But here is some evidence that this is the case. So Hofstede was a Dutch researcher who worked at IBM. Now he actually had access to results from a questionnaire that IBM produced that covered 40,000 of their employees globally. Now, you've controlled for income, you've controlled for social status, you've controlled for education. And what he managed to do was he managed to take those particular answers and distill them into characteristics in terms of countries. Now, this is, again, he wasn't thinking in terms of asset markets at all here. He was thinking purely in terms of IBM. How can we actually engage our employees better? How can we manage their expectations better? And the reality is that he found that he could categorize people's answers into these 6 different categories. And you can see here that Australia and Canada, for example, are very individualistic. So that's the second one along. But we also have a short-term orientation. So in Australia, what does this mean? It means, for example, in Australia, we're much more likely, if we do a good job for our boss, for our firm, we expect to be paid a bonus. In Japan, people join firms for life. The salary is actually almost secondary to their identity in terms of their firm. Australians move jobs much more often. We are much more individualistic in that sense. We also have a far shorter term orientation. And again, you've got to think about this when you're talking to investors about their particular portfolios. They're much more likely to take a short-term view. Now, what that means is, for example, you see that in engagement in superannuation. So when people talk about superannuation, we need to increase engagement. My view is you're actually pushing against something which might be deeply cultural. Now, again, so what you can see here, Australia and Canada, individualistic, short-term orientation cultures. Singapore and Japan, the opposite. And as a result, Singapore is the 3rd worst momentum market. Japan's the worst. Australia and Canada are the 2 best. Now, often we talk to investors and say, well, okay, that's just because they're resources markets. Reality is that misses the point. It's actually cultural. Now, when you start to see these cultural dimensions change, then you'll start to see factors trade differently in Australia. That's my view. So when I say the trend is your friend, I will maintain that statement until we start to see a different approach to individualism or long-term orientation. So I mean, again, one of the things in terms of long-term orientation is that in Australia we have, anecdotally, I think we have more gambling machines in Las Vegas per head of the population, right? The amount of people who are willing to, take a punt, and that's a short-term view of the world. So anecdotally, this also matches as well. So momentum works across time, geographies, and asset classes. It has a justification in behavioral bias, but that's not the end of the story. The justification is also cultural. So those biases, again, that you often see talked about in talks like this, it's very important to remember the culture that you're actually talking about them within. And linking these culture to momentum profits means that we can be confident that this sort of thing, as in the trend is your friend, in Australian equities, is the dominant psychology driving Australian equities. So again, in terms of dealing with managers or dealing with your portfolios, the one thing you should have in the back of your mind is, how does this manager deal with momentum? Do they even admit its existence? And if they don't, why not? And they should have a good answer, because they are fighting in the face of all of this evidence, both academic and practically, for this. Now again, caveat number 2, is that the reality is that even though momentum is so strong in Australia, even though it works so well, the reality is that the drawdowns are sharp and fast. And in fact, I would argue the reason it exists in Australia is exactly the same reason that people don't want to invest in these types of strategies or even don't think about it. People are risk averse. Losses hurt twice as much as gains. And so with momentum, you're seeing that these sharp drawdowns in the GFC and particularly and recently as well, even those are included in all of my calculations, in all of our results showing that momentum works over a very long time period. The reality is that people say, I do not want those drawdowns. So it's very, very important when you're thinking about momentum strategies to think about risk control, particularly in the light of the first bias we talked about, as in losses hurt twice as much as gains. So the last thing you want to do is invest with a client right at the top here and say, okay, no, we're going to be fine, just take a 5-year view. You know that's not going to be possible. We know that the biases are actually going to work against that. And the very biases that I talked about initially are then going to lead to people exiting momentum right at the wrong time. So to me, that's really the key point here. The reality is that momentum exists for the same reason people don't want to invest in it. The same reason people are averse to it is the whole reason it exists. So, know the markets. Factors, in my view, provide investors with different returns in different markets. Now, building a portfolio from certain factors can be very efficient from a cost perspective, can be very efficient from a risk-reward perspective as well. The reality is that the last thing you want to do is take a model that was built somewhere else and put it in Australia. It just won't work as well as a model that's designed for the Australian market. Use the factor that's most suitable to the market. The very reason momentum exists is the very reason that makes investors nervous. And that's why it is possible to make money from this, and that's why it's possible that this will not disappear in next year, because there'll always be some people who are nervous. There'll always be some people who won't like this strategy. And while they still exist, momentum will exist as well. And again, you can link that back to your clients as well. When you've had a drawdown, losses hurt twice as much as gains. I mean, there's a whole lot of evidence for that. Yes, that came from the US, that information, but culturally, that seems to be almost something that's universal. Those losses means that your clients are going to be most engaged after drawdowns. They're going to need you most when they've lost money or their strategy isn't working as well as they thought. And again, that's something that maybe you should think about asking more specifically in investment questionnaires as well. So, in Australian equities, the trend is your friend. There's a whole bunch of biases that justify why this might be the case. We're also finding that these biases are cultural. they depend on where you are in the world. And as a result, the Australian equity market, as with Canada, is much more amenable to strategies which exploit the trend as your friend. So if you remember nothing else in the sense of when you're talking to managers, when you're talking to clients, be aware that they should be aware of the trend. If managers aren't aware, you should ask them why. If they don't have a good answer, then you should start to question why they're investing in Australian equities, how they're investing, what's their real biases, what's their exposures really like. So in terms of Australian equities, remembering that the trend is your friend, both for individual stocks and individual managers, is the adage that I personally think is most important.